Welcome to our deep dive into factor investing. We've got a ton of material to go through, so let's unlock the secrets of these hidden market forces. Forces that can really change how you think about investing.
It's almost like there are certain personality traits in stocks that can give your portfolio an edge, beyond just the company's performance. That's what we're talking about with factor investing.
So it's not just about picking good companies, but understanding these deeper market dynamics. How did factor investing come to be? Where did it all start?
Well, it actually evolved from a model called CAPM, the capital asset pricing model.
PEPM, right?
Yeah, CAPM suggests that a stock's risk and return are tied to its sensitivity to the market, what's called beta. Factor investing goes further than just market exposure, seeks out smart betas.
So rather than simply riding the market wave, we're looking for ways to strategically outperform it. How did this shift happen from CAPM to multi-factor investing?
A lot of academics and practitioners, especially those focused on quantitative analysis, started finding factors beyond market beta that could influence stock returns.
Beyond just that basic beta.
Exactly. A key breakthrough was the work of Fama and French. Really pivotal. They showed that a company's size and valuation are major players in its stock price. This challenged the efficient market hypothesis, suggesting you can actually beat the market by targeting these factors.
It's a pretty big deal for investors. Let's get into the factors themselves, starting with size. What makes this a significant factor?
The size factor is based on the small cap premium. Historically, smaller companies have delivered higher returns than their larger counterparts because of their higher risk profile.
So higher risk, higher potential reward.
Yeah, they tend to be more volatile, face a greater risk of going bankrupt. So investors want higher returns to compensate for that added risk.
Makes sense. How can investors tap into this size factor?
It's actually pretty accessible. You can invest in a small cap fund or an ETF that specifically tracks a small cap index. Gives you direct exposure to that small cap premium.
Sounds pretty straightforward. Let's move on to the next factor, value. This one seems rooted in a pretty classic investment approach.
You're right. It stems from the principles of value investing, championed by investors like Benjamin Graham,
Oh yeah, of course.
who advocated for buying stocks that are undervalued compared to their intrinsic worth, finding those hidden gems that the market might be overlooking.
All about finding those bargain stocks with growth potential. How do we measure this value?
There are several metrics. A common one is the book-to-price ratio, which compares a company's book value to its market price. Another one is earnings yield, looks at earnings relative to price. Higher book-to-price ratios or earnings yields signal a potentially undervalued stock.
We're essentially looking for companies that are trading at a discount. What about this multi-factor approach to value investing? I've heard that term.
Right. Many investors prefer a multi-factor approach to value investing, rather than relying on just one metric. This involves combining various value metrics. You create a more diversified and potentially less volatile exposure to the value factor.
Diversification is key, as always. Okay, let's explore momentum. What's the idea behind this factor?
Momentum investing rides the wave of market trends. Stocks that have performed well recently are likely to continue doing so, at least for a while. This is often explained by behavioral economics.
Interesting.
Investors tend to underreact to new information or trends initially.
So the idea is that once a stock starts gaining momentum, investors pile in, pushing the price even higher. How do we measure momentum?
Typically, we look at a stock's 12-month price returns. Strong price growth over the past year indicates high momentum. Momentum investors are basically betting on the continuation of those existing trends.
It's about understanding the psychology of the market and capitalizing on trends. Now let's talk about quality. Seems intuitive to want to invest in high-quality companies, right?
Right.
How does this translate into a factor?
Quality as a factor is a bit more nuanced than it might seem at first. There isn't really one definitive definition, but high-quality companies generally share certain characteristics.
So what should we be looking for when assessing quality? What are the signs?
Focus on companies that are fundamentally sound, profitable with stable cash flows and strong balance sheets. These companies often have a competitive edge in their industry, allows them to generate consistent profits.
I see.
Think of companies known for good management and the ability to weather economic storms.
Quality is about looking beyond short-term fluctuations and finding those companies with resilience and consistent profitability. That makes sense. Our last factor for today is low volatility. Seems like a way to minimize risk in a portfolio.
You're right. Low volatility investing aims to smooth out the ups and downs of investing. It involves choosing stocks that have historically lower price fluctuations than the broader market.
This factor probably appeals to investors who are a little more risk-averse, who wouldn't want a less bumpy ride in the stock market.
Right. The idea is to achieve market-like returns with reduced risk. These low volatility portfolios tend to perform well during market downturns, adding a level of stability to your overall holdings.
It's like having a built-in shock absorber for your investments. Yeah. But we should remember that these 5 factors are just the starting point for understanding this world of factor investing.
Yeah, that's an important point. There's a much wider universe of factors beyond these 5 core ones. New factors are constantly being researched and explored, and factor performance isn't static. It goes through cycles. No single factor is always the winner.
So it's not as simple as just picking a factor and riding it to success. What should investors keep in mind about this cyclicality?
Each of these factors experiences periods of both outperformance and underperformance. No single factor wins all the time, which is why diversification is absolutely essential in factor investing.
That makes sense. Diversifying across factors seems like a way to hedge against the ups and downs of any single factor.
Exactly. By diversifying, you can potentially capture positive returns no matter which factor is in favor at any given moment. This can lead to a more stable and predictable investment experience over the long term.
This has been a really helpful breakdown of these core factors. It's clear that factor investing offers a powerful way to understand and approach the market. But I'm also sensing there's a lot more to uncover.
Absolutely. Choosing specific investments based on these factors requires careful consideration. Not all strategies are created equal. And there are nuances to factor definitions and performance that we need to explore further.
That's a perfect segue to the next part of our deep dive. We've built a foundation for understanding these key factors that drive market returns. Now let's shift gears. How do we put all this knowledge into practice?
This is where it gets really interesting, moving beyond the theory and actually exploring how to build a portfolio based on these principles.
That's what I'm most curious about. Where do we even begin? Constructing a factor-based portfolio.
The first step is understanding your investment goals, your risk tolerance, time horizon. These are fundamental considerations for any investment strategy, really.
So it's about knowing yourself as an investor before diving into specific factors. How do those individual characteristics actually influence our approach to factor investing?
Let's imagine a younger investor. Longer time horizon, higher risk tolerance. They might be comfortable allocating a larger portion of their portfolio to factors like size and value.
Because those have historically offered higher potential returns.
Exactly, although with greater volatility, of course.
Those factors align well with a long-term growth strategy. Someone nearing retirement, though, might have different priorities.
Right. An investor approaching retirement might focus on preserving capital, generating income, so a greater allocation to low volatility stocks or quality companies might be more appropriate, aiming for a smoother ride and consistent dividends.
So it's about tailoring your factor exposure to your specific situation. Once you have a sense of your factor preferences, how do you actually go about building that portfolio?
There are a couple of approaches. One is to directly select individual stocks based on your chosen factors.
Okay.
However, this can be pretty challenging and time-consuming. Requires extensive research, data analysis.
That sounds pretty intensive.
Yeah.
Especially for someone who's not a professional quantitative analyst. Is there a more practical method for individual investors?
Yes. The most common and accessible route is through exchange-traded funds, ETFs.
ETFs, right. A popular investment tool. How do they work and how do they apply to factor investing?
An ETF is essentially a basket of securities that trades on an exchange, just like an individual stock.
Right.
The beauty of ETFs for factor investing is that they're designed to provide targeted exposure to specific factors. You can find ETFs that focus on size, value, momentum, quality, low volatility, even combinations of multiple factors.
So instead of picking individual stocks, you can buy a prepackaged basket of stocks that embodies a chosen factor. That seems much more manageable.
It's a highly efficient and cost-effective way to implement factor investing. These ETFs typically track indexes that are specifically built around certain factor definitions and methodologies.
So we're relying on the expertise of index providers to select and weight the stocks within the ETF. Take some of the burden off the individual investor.
Exactly. Index providers have the resources and expertise to do the heavy lifting, constantly monitoring the market, updating their methodologies, rebalancing their indexes. So it ensures that the ETF accurately reflects the intended factor exposure.
That makes sense. But it also emphasizes the importance of choosing the right ETF, right?
Absolutely.
You can't just pick any ETF that happens to have value or momentum in its name.
Absolutely. Due diligence is crucial. You need to carefully examine the ETF's prospectus, fact sheet, other available information. Pay attention to how it defines and measures the target factor, what its underlying holdings are, its expense ratio, and its historical performance.
Aligning your ETF choices with your investment strategy. Now let's talk about diversification. We've touched on it as a key principle in factor investing. How do we diversify across factors within a portfolio?
One approach is to allocate a portion of your portfolio to each of the 5 key factors. You might divide your portfolio equally among 5 ETFs, each targeting a different factor.
Okay, so an equal-weighted approach to factor diversification. That sounds like a reasonable starting point.
It's a good starting point. However, you can also adjust your factor allocations based on your risk tolerance, time horizon, and views on the market.
So, for example, if you're bullish on value stocks, you might allocate a larger portion of your portfolio to a value-focused ETF.
Exactly. Or if you're worried about market volatility, you might increase your allocation to low volatility stocks. The key is to customize your portfolio based on your individual circumstances and outlook.
It seems like there's a balance to strike between having a basic framework for diversification and making tactical adjustments as needed.
You're exactly right. It's about having a solid foundation and then adapting to changing market conditions.
Let's make this more concrete. Could you walk us through a hypothetical scenario of constructing a factor-based portfolio using ETFs?
Sure. Let's consider a hypothetical investor. Moderate risk tolerance, long-term investment horizon, wants to build a diversified portfolio using factor-based ETFs. We could start by allocating 20% to each of the 5 key factors: size, value, momentum, quality, and low volatility.
An equal weighting across the 5 factors. What specific ETFs could we use for each factor?
For size, we could look at the iShares S&P Small Cap 600 Value ETF. This ETF tracks an index of small cap value stocks, gives us exposure to both the size and value factors.
So we're getting a 2-for-1 deal there. What about value?
For a broader exposure to value, we could consider the Vanguard Value ETF. This ETF tracks a wide range of large cap value stocks.
Okay. What about momentum?
A good option for momentum is the iShares MSCI USA Momentum Factor ETF. Tracks an index of large and mid-cap stocks with strong price momentum.
Okay. For quality, what would you suggest?
The Invesco S&P 500 Quality ETF is a strong contender. Tracks an index of S&P 500 companies, high-performing in areas like profitability, financial leverage, and earnings quality.
And finally, for low volatility.
The iShares MSCI USA Min Vol Factor ETF is a good choice. It focuses on U.S. stocks that have historically demonstrated lower volatility than the broader market.
With those 5 ETFs, we've built a hypothetical portfolio. Offers diversified exposure across those 5 key factors. Of course, this is just an example. The specific ETF choices and allocations would depend on the individual investor's needs and preferences.
That's right. This is just a starting point. Thorough research and due diligence are essential. Make sure the ETFs you choose align with your investment goals and risk tolerance. Remember, you can customize your factor exposure, tilting the portfolio towards specific factors based on your own market outlook.
So there's flexibility within this framework. Adjust based on individual convictions and preferences. We've talked about choosing ETFs, allocating to different factors, customizing the portfolio. What about rebalancing? Since factor performance can be cyclical, how often should we be revisiting and potentially adjusting our factor allocations?
Rebalancing is crucial, especially for factor-based strategies. As factors go through their cycles, your initial allocations can drift,
Right.
potentially leading to unintended exposures and increased risk.
So if value stocks have a strong run, our value allocation might become overweight, making the portfolio more susceptible to a future downturn in value stocks.
Exactly. Regular rebalancing ensures that your desired factor exposures remain aligned with your goals and risk tolerance.
Is there a standard time frame for rebalancing?
There's no one-size-fits-all answer. Some investors prefer to rebalance annually, while others do it more or less frequently. Depends on their preferences and market conditions. The important thing is to find a frequency that works for you and to be consistent.
So establish a routine and stick to it. And it sounds like rebalancing doesn't necessarily mean making major changes.
Often, rebalancing just involves making small adjustments, bringing your factor allocations back in line with your targets. It's about fine-tuning the portfolio, not overhauling it.
This brings us to another important aspect: monitoring. How actively should investors be monitoring their factor-based portfolios?
Regular monitoring is key. Make sure your portfolio is on track and your factor exposures remain aligned with your strategy. Stay informed about your ETF's performance, their underlying holdings, and any changes to index methodologies or expense ratios.
So it's not a passive approach. Factor investing requires a certain level of engagement and attention.
That's correct. Factor investing is an active strategy. It necessitates staying informed, adapting to market changes, making adjustments, staying aligned with your goals. But that doesn't mean you need to be glued to your screen 24/7. Find a balance between staying informed and avoiding overreacting to short-term noise.
This has been very helpful, discussing how to translate factor theory into a practical investment approach. Portfolio construction, ETF selection, diversification, rebalancing, monitoring. Feels like we've addressed most of the key elements.
We've covered a lot of ground, but there's one more crucial aspect of factor investing that we need to emphasize.
Okay, and what's that?
Patience.
Patience. That's an interesting point to highlight. Why is patience so important in the context of factor investing?
Well, factor investing is not a get-rich-quick scheme. It's a long-term strategy, grounded in capturing those premiums associated with specific factors over an extended period. There will inevitably be periods of outperformance and underperformance.
So it's about riding out those cycles and trusting the process.
Exactly. Don't get discouraged by short-term fluctuations. Stick to your plan. Maintain diversification. Let the power of factor investing work its magic over time.
Powerful reminder that investing is a marathon, not a sprint. And it seems particularly relevant in the world of factor investing.
Absolutely. The key takeaway is to approach factor investing with a long-term perspective. Focus on the fundamentals. Stay disciplined. Let time work in your favor.
This has been an incredibly insightful look into the practical side of factor investing. We've moved beyond the theoretical and explored how investors can build and manage a portfolio based on these principles. But the world of factor investing is always evolving.
That's right. There's a whole frontier of new and emerging trends that are shaping the future of factor investing. And those are the trends we'll explore in the final part of our deep dive.
Now it's time to look ahead.
Right, we've really just focused on those 5 core factors. But the world of factor investing is so much bigger than that. New factors are emerging all the time.
That's what makes this such an exciting field. What are some of those new factors that investors should be aware of? What's on the horizon?
Well, one area that's getting a lot of attention is ESG, environmental, social, and governance factors.
ESG. I've heard that term a lot lately.
Yeah, investors are increasingly looking at a company's sustainability practices, their social impact, alongside its financial performance, of course.
So it's not just about profits anymore. Investors are looking at the bigger picture, a company's impact on the world.
Exactly. And there's growing research that suggests that companies with strong ESG profiles might actually outperform their peers over the long run.
Interesting. So aligning your investments with your values doesn't necessarily mean sacrificing returns. Are there specific ETFs or funds that target these ESG factors?
Oh yeah, absolutely. There's a growing number of ESG-focused ETFs available. They typically track indexes that incorporate ESG ratings and metrics into their stock selection process. Gives investors an easy way to align their portfolios with their values while still aiming for strong performance.
What other new factors are on the horizon? What else is out there?
Another really interesting development is alternative data.
Alternative data.
Traditionally, investors have relied primarily on financial statements and market data to make decisions. But now there's a whole universe of alternative data sources that can offer insights.
Like what? What kind of alternative data are we talking about?
Think of data that's not typically found in those traditional financial reports. Satellite imagery that tracks foot traffic at retail stores.
Wow.
Social media sentiment analysis to gauge consumer opinions. Or web scraping that analyzes online activity, trends.
It sounds like we're entering this era of big data in investing. What are the implications of this shift towards alternative data?
It's still a relatively new area, but it has the potential to completely change the way we evaluate companies, construct portfolios. It gives you these unique and timely insights to complement that traditional financial analysis.
So factor investing isn't just about those traditional factors anymore. It's constantly adapting, incorporating new data and insights to really uncover those hidden drivers of return.
Exactly. And as factor investing continues to evolve, I think we can expect even more innovative approaches to emerge.
Any predictions about what the future holds? What trends should investors keep an eye on? What's next?
One trend that I think is going to have a major impact is the integration of machine learning and AI into factor investing.
AI in investing. That sounds pretty futuristic.
It might sound like science fiction, but it's becoming a reality. These AI algorithms can analyze huge amounts of data, identify complex patterns, and potentially even predict future performance with greater accuracy than humans.
We're talking about algorithms that can maybe discover new factors, refine existing ones, and construct highly optimized portfolios.
Exactly. This has the potential to revolutionize factor investing, leading to more sophisticated strategies and potentially even higher returns.
This is a really exciting development. But it also raises some questions. Is this level of AI-driven investing even accessible to individual investors?
Well, for now, AI-powered investing is mostly used by large institutions. But as technology advances and becomes more affordable, I think we'll see these AI-powered tools and strategies become available to individual investors as well.
That would be a game changer. Making sophisticated investment strategies available to everyone. It really highlights the dynamic nature of factor investing, its constant evolution.
It's an exciting field to be in, and I think we'll continue to see innovation and new discoveries really push the boundaries of what's possible.
This deep dive has been a real journey of discovery, from the foundations of factor investing to those cutting-edge trends shaping its future.
We've seen that factor investing isn't just some academic theory, it's a practical approach that can be incorporated into any investment portfolio, with the potential to enhance returns, manage risk, and navigate this ever-changing market.
As we wrap up this deep dive, what's the key takeaway for our listeners who are interested in exploring factor investing? What do they need to know?
I think the most important thing is to approach factor investing with curiosity, a willingness to learn, and a commitment to building a portfolio that really matches your individual goals and risk tolerance. Stay informed about new factors, new strategies, and technologies. All these things can help you make more informed investment decisions.
Stay curious, keep learning, and happy investing.